Welcome to session 5 of the Rebel Income Coaching Program. Along with the concepts and terminology you learned about in session 4, it's also important to understand some of the ways that traders measure different option dynamics such as time decay and leverage. The tools I'm about to show you can be used to compare an option to its underlying stock, as well as to differentiate between multiple option contracts in the same option chain. They can also help you to forecast option price movements so you can measure a contract's potential reward to its risk. Now, we've already talked about some of these tools already. In this session, we're going to take a closer look at what they mean and talk about how to recognize them. We'll also discuss some of the unique metrics called option Greeks that you can use that you can also make use of to inform your trading decisions. When the price of the stock underlying an option moves past that option strike price, we call it in the money. One of the ways to think about an in the money option is to think of it as having equity in the underlying stock. Just as the owner of a $200,000 home, while owing $150,000 on it, would have positive equity in the home. In options, equity is referred to as intrinsic value. To determine how much intrinsic value an option has, all you have to do is calculate the difference between the option strike price and the current price of the stock. If your result's a positive number, then that is the amount of intrinsic value that the option has. Options never have a negative intrinsic value. It's either positive or zero. Just as a homeowner who owes more money than a house is worth, just as a homeowner who owes more money than a house is worth is simply said to have no equity in the home. This is why out of the money options have an intrinsic value of simply zero. Let's talk about how calculating intrinsic value really works. Remember that your broker will generally show in the money options by shading those strike prices and their information. So you already know those are the contracts that will have a positive number following this calculation. The higher the number, the deeper in the money the option will be. For call options, subtract the option strike price from the stock's current trading price. For the option chain I'm showing you here, the $92, $93, and $94 call option strike prices all would result in a positive number. Now, for put options, you subtract the stock's current trading price from the option strike price. In this case, excuse me, apologize. For put options, you just subtract the stock's current trading price from the option strike price. In this case, you have the $95, $96, and $97 put option strike prices that would all result in a positive number. Most aggressive put sellers will sometimes consider using in the money options for their income trades. This can become even more tempting if the option's bid price is significantly higher than the amount of intrinsic value. The $95 strike price put option is an interesting example, since the last trading price for the stock is 92 cents below 95. The bid price for this option of $2.21, on the other hand, is nearly $130, excuse me, $1.30 per share higher than the total intrinsic value of the option. You can also consider out-of-the-money options and calculate their negative intrinsic value to make the same determination. The $94 strike price put option, for example, has a negative intrinsic value of negative 0.08, which is the same amount the option is out of the money. With a bid price of $1.77 per share, however, this put option's current trading price is even more elevated than for the $95 strike price. This isn't common, but when it does happen, it can offer very interesting opportunities for a smart income trader. All options have two primary components to their price: intrinsic value, which we just talked about, or its absence, and time value. This fact is the reason that calculating time value is as simple as finding the difference between an option's bid price and the intrinsic value that you've just determined. Any remaining value must, by definition, be related to the amount of time remaining to expiration. Remember that only in-the-money options have any intrinsic value. That means that for out-of-the-money options, all of the options price can be attributed exclusively to time value. Now, if we consider the $94 strike price call in our chain for RTX, which is in the money by only 8 cents, against this $2.17 bid price, the implication is that this call option has $2.09 of time value. On the other hand, the $94 strike price call has $1.08 of intrinsic value against its $2.81 bid price. The 94 strike price call has $1.73 excuse me, the $94 strike price call has $1.73 of time value, which is less than the 95 strike price call that expires on the same day. This is a reflection of the reality that while these options have the same time to expiration, they lie at different distances from the stock's current price. They also operate as separate securities with their own levels of trading activity that are separate and distinct from each other, and that can inflate or deflate the time value side of the equation at any given time. The put side of this option chain provides a similar point of view. The $94 strike price put and all strike prices below it are out of the money. Since these contracts have no intrinsic value, we can assume that the bid prices for each one reflect their time values. But again, each one has a different amount of time value left. Since $92 is further away from the stock's last $94.08 trading price than either $93 or $94, the difference can be partially explained. But also keep in mind that each contract has a different level of trading activity that can shift the time value side of the equation at any given time. Over time and through experience, you'll learn to recognize quickly when an option has what looks like a normal amount of time left and when it may be exaggerated. Until then, there is another useful metric that you can access easily to help you arrive at the same conclusion, and that we'll take a look at in just a moment. I've expanded my options chain here to show you some different expiration periods, and so you can see how time value changes. In fact, it accelerates the closer to expiration an option gets. This option chain, we can see, lists the available options by expiration from top to bottom. So the options at the top are closer to expiration than those at the bottom. Let's use the $94 strike price on the put side for our example. For the option that has a little over a week left, we can see there's $1.10 of essentially time value remaining. Since this is out of the money, this is everything that is left for the next 9 days. If we go out an extra week, we can see that this same put option with a bid price of $1.39 has a little bit more time value. If we go out 23 days, then we see that it changes to $1.77. So as we get closer to expiration, we see these premiums, we see the time value remaining in these options decrease and melt away, similar to an ice cube. You'll also notice that the difference between time value from one option contract to the next is more exaggerated when you look at longer periods of time, a month or more, compared to any expirations within less than a month of time. But regardless, this does give you an idea of exactly how time value erodes each day that an option gets closer to expiration. The difference between the bid prices for option contracts at different time expiration dates, but at the same strike price that we just used, provide a good visual reference for the reality of time decay. We can also consider time decay using an option Greeks metric that helps us to arrive at an estimated value to the same effect. Let's take a look at that now. Under the chain type heading for this broker's interface, clicking on Greeks Analytical will change the view of our option chain. What we will see will be some of the same pricing information, but with some additional information shown to the right of each option contract. In this case, the column labeled Theta, and that I've highlighted in blue, gives us an estimated amount of daily time decay for each option. Since Theta reflects daily time decay, you'll always see it reflected as a negative number for both call and put options. You can also think of the number shown as a per share number. For the $92 strike price call in this option chain, a Theta value of minus 0.048, we have right here, means that this option loses a little less than 5 cents per day to the effective time. If a stock moves in the direction an option favors, for example, a stock moves up when you've bought a call option, the effect of time decay will be less noticeable because of the impact of the option's increasing intrinsic value. It's still there, and it can still be counted on even when the market isn't open. Time decay is an element that plays a role each day that the option exists until its expiration. It's 7 days a week, 365 days a year. Notice also that Theta increases the further an in the money option is. And it also decreases the further out of the money an option may be. For option sellers, for the purposes of the Rebel income system, Theta is a useful way to measure the amount of time decay an option, call, or put experiences. Now, the caveat is that theta is an estimate that is calculated on a daily basis. That means that today's time decay number won't be the same tomorrow or next week. You'll generally see theta increase the closer to expiration an option becomes, because as I already mentioned, time decay melts very much like an ice cube that you hold in your hand. At first, it melts gradually, but the smaller it gets, the faster it melts until there's nothing left. All right, another interesting measurement that we can use from the option Greek screen is called theoretical value, or t-value for short. This is a measurement that every broker will calculate for you using an algorithm commonly known as the Black-Scholes method. The specifics behind the method are far less important than knowing how to use it. The t-val for each option contract listed is displayed in the column I've highlighted in blue. When you compare an option's t-val to its bid price, you get a clearer reference for whether an option may be inflated, deflated, or trading at a reasonable level to the amount of time left. For example, if I compare for the $92 strike price call, here's a theoretical value of 3.58 against a bid price of 3.5. It's only a slight difference, a little bit less than 4 cents between the two. That is relatively minimal and implies that these options are trading that this option is trading at a reasonable level. In the case of all of the call options, you can see, in fact, the t-val is only slightly higher than the bid prices for each option. So all of these options are trading at relatively reasonable levels. In the case that you see a bid price significantly higher than the t-val, you can also assume that option prices are elevated above normal levels. This isn't something that's common, but when you do see it, these instances often represent even more interesting income opportunities for option sellers and for the Rebel income system, because the yields available, even at conservative out-of-the-money strike prices, will be higher than normal. If the bid price is significantly lower than the t-val, and when I say significantly, I'm usually talking about 25% lower or more lower than the t-val, you can assume that option prices are generally deflated below normal levels. Now, that's an opposite condition from the ideal selling environment that comes when options are inflated, but it doesn't automatically mean that a stock's options aren't useful for income generation with the Rebel income system. It might mean that a stock's options have a lower relative level of trading activity compared to other stocks. Often that makes options for these stocks less liquid and harder to trade than normal. That doesn't mean that you can't use them, but it does mean that each trader has to decide for themselves if these conditions, if these are conditions that they're willing to work with. As much as possible, the trades I highlight in the Rebel income system try to focus on fairly valued or inflated options, and my general preference is to try to avoid situations where liquidity and trading fulfillment may come into question. I've highlighted the open interest column in blue on the far right of both the call and put sides of the option chain shown here. Open interest is something that tells you how many open orders for each strike price are waiting to be filled. Open interest doesn't describe buyers versus sellers because an open order can be submitted by either a buyer or a seller. And that order can simply sit open in the marketplace until another trader comes along to take the other side. Even so, a high level of open interest is a good way to see how actively traded an option contract is, and therefore how quickly an order is likely to be filled. A simple benchmark for healthy open interest in any given contract is 100. The volume columns for both puts and calls are highlighted in orange. Where open interest only describes the number of open orders, volume reflects the actual number of contracts at each strike price that have changed hands. While not as important as open interest in describing how liquid an option contract may be, it is still useful in illustrating how actively the market is trading each contract. while open interest has kind of a minimum benchmark, ideal is at least 100 contracts. Volume doesn't have a set number to look for. There's not a minimum amount to look for. It's the basic guideline when you're talking about options volume is simply the higher the volume level, the better. Apologize, let me manage my screen here for a moment. There we go. That's better. All right, let's talk about volatility for a moment. Historical volatility is a measurement that you may hear option traders talk about a little bit. This is a number that is used to describe how much a stock price has changed over time. By itself, historical volatility doesn't provide a ton of insight unless you've been paying attention to it over time. Suppose, for example, that a month ago, historical volatility for RTX, in this case, was 10%. With this figure now a little above 24%, as I've highlighted in blue in the lower left-hand corner, the implication would be that the stock's price fluctuations have increased in range and severity over the past month. The most practical use of historical volatility for options trading comes when you can compare it to our next volatility metric, which is implied volatility. Implied volatility is a measurement that you will find with the option Greeks, and I've highlighted it here in blue. The most practical use of implied volatility for option sellers comes when comparing the implied volatility of the contract you're interested in against the historical volatility of the stock. If implied volatility is higher than historical volatility, options premiums will generally be inflated, meaning that buyers have to pay more to trade those contracts, while sellers are able to enjoy those, the inflated premiums in the form of additional cash in their accounts. Higher implied volatility versus historical volatility is kind of an ideal, but not a required situation or condition for a functional trade in the Rebel income system. For RTX, we can see that the implied volatility for the $94 strike price call is just a little bit above 20, while as previously mentioned, the historical volatility for the stock was about 24.4. Lower implied volatility can mean that an option doesn't trade as actively. And that generally also means that premiums may be somewhat deflated. But when you consider that the bid price in this case for this option contract is $2.17 for the $94 strike price call, this could still provide a useful covered call opportunity with a yield of a little over 2% for a trader who doesn't mind holding the stock, while using options to pay themselves a useful dividend for the next 3 weeks of time. This means that while the comparison of implied volatility to historical volatility can be a useful way to help you understand whether or not an option's bid price is inflated, it really fits more into the category of a nice to have element rather than a have to have element for a practical trade. All right, finally, let's talk a little bit about delta. Delta is a popular option Greek metric for option buyers. For these traders, delta provides a bang for your buck view for how much an option's price may change relative to its underlying stock price. In literal terms, delta is a percentage reflection for that relationship. Let's use again that $94 strike price call for RTX as an example. With the stock's current price at 94, excuse me, at 94.08 and a delta value of 0.544, we can infer that if RTX increases in price by $1, the $94 strike price call will also increase in value by 54 cents per share. If the buyer paid the $2.24 ask price also shown, that also means that for a $1 change in price for RTX, a little over 1% in the stock, the option is going to increase in value by about 20%. That's leverage, and it's why most option buyers stick with buying strategies almost exclusively. Now, the flip side of leverage and delta is that it cuts both ways. Remember that delta tells you how much the option will change in price for every $1 change in the stock. That also applies to a move in the opposite direction. If RTX decreases in value from 94.08 to 93.08, then the call option shown here, excuse me, will also lose a little more than 54 cents per share in value. The leverage nature of the option contract is the reason that smart option buyers move quickly to take profits when they have them and more quickly to minimize losses when the stock moves against their option. Keep in mind also that the delta values I'm showing here for calls are positive numbers. Let's take a minute and let's take a look at some put options and give you an idea of what these look like. Going to expand this a little bit. Go to the Greeks. Stick with June. Okay. Now again, by default, our option chain looks the same as pretty close to the same as in the screenshots that we were looking at. We can see that the price for Raytheon is a little bit different in this case, 93.66. Let's switch over to put options. Now, if we look at the same $94 strike price, which is a little bit in the money in this case, we can see that the delta value is a little over 52 cents. Remember also that there we go, sorry about that, a little over 52 cents per share. All delta values for put options are going to be shown with negative numbers. That is simply a way to reflect the generally bearish nature of put option contracts, at least for buyers. However, the math is exactly the same. This 50.523 value means that for every $1 that RTX changes in price, the June week 2 94 put will also change in value by a little over 52 cents. Now, since we're talking about put options, remember that the logic is reversed. If the stock goes down by $1 and is tomorrow at 92.66, then that means that the option is going to increase in value by 52 cents. So instead of $1.32 on our bid price, we would be looking at a bid price in the neighborhood of $1.84 per share. If the stock goes up by $1 from 93.66 to 94.66, excuse me, then this option will lose 52 cents per share in value, will drop in that case down to about 80 cents per share on the bid price, would be the expectation that we would have. What this does is to give you a reference point for how much an options price can change if the price of the underlying stock also changes very quickly. Now, as with all option Greek measurements, remember that delta is only ever an estimate. So for option sellers, delta is primarily a reference point, such as in the case of implied volatility and historical volatility. In the case of a put sale, for example, it can serve as a reference point for how much extra you could be forced to pay above and beyond the premium you brought in when you first placed the trade to close out an open put sale if the stock drops sharply. That could be useful if your intention is to avoid assignment from that put selling trade. But the truth is that if you intend to avoid assignment, the simple rule should be to buy back the option quickly if the stock drops sharply below the strike price you've sold. Don't worry about trying to figure out if the price you have to pay to get out of the trade and close out the potential obligation of the put sale matches the price you estimated you might have to pay at the beginning of the trade. For the purposes of the Rebel income system, delta is an interesting metric, but as I've hopefully illustrated here, it's not a necessary part of the analysis that we use to place our functional income trades. Okay. Let's talk about the session ahead. In session 6, we're going to get specifically down to the nitty-gritty and talk about income generation with the primary trading strategy we use in the Rebel income system, which is selling puts. We're going to talk about why we like to sell puts and some of the rationale behind this particular strategy. We'll talk about putting time on your side, which we've already alluded to a little bit with the discussion of time decay. We'll also make sure to illustrate the difference between what brokers like to call naked puts which also involves margin trading, and cash secured puts. The difference is important and can not only dictate the way that you decide to treat your option trades, but may dictate whether or not put selling is available for the account that you're thinking about using them in. We'll also go over the basic rules related to the Rebel income system. We've outlined some of the foundational elements of that system, like fundamental analysis, valuation analysis, price action and trends, etc. But we'll really dive into exactly what those rules are for the Rebel income system so that you can see exactly how those are supposed to work. Thanks for your time. I hope you have found this to be useful. I will talk to you again in the next session.